Solved problems. CVP analysis. Profit volume ratio. Contribution margin ratio. Break-even point. Margin of safety. Operating leverage. Prediction of profits on increase in sales. Problem. The Vice President of Sales, Ridge Guerrero, estimates that the variable cost per product unit will increase from 80 to 95. The selling price is expected to remain P20. The fixed costs for the year amounted to 340,000. Last year, the company sold 30,000 units of products and expects to sell the same quantity this year. Guerrero is concerned about the loss in profitability because of increased costs. He asks you to prepare an evaluation of what changes are taking place. Required. What is the contribution margin ratio for this year and last year? B. What is the break-even point in sales PEXELS for this year and last year? C. Calculate the margin of safety for last year and this year. D. Compute the operating leverage for this year and last year. E. Explain what would happen to profits this year if the sales volume could be increased by 15%. Hi friends, in this problem we need to find out 1. Contribution margin ratio, 2. Break-even point, 3. Margin of safety, 4. Operating leverage, 5. Prediction of profits on increase in sales. 1. Calculation of contribution margin ratio this year, last year. Quantity this year 30,000, last year 30,000. Selling price per unit 120 this year, 120 last year. Variable cost per unit this year 95, last year 80. Sales this year 30,000 into 120, 3,600,000. Last year 30,000 into 120, 3,600,000. Less variable cost 2,850,000 this year, last year 2,400,000. Contribution. Sales minus variable costs 750,000 this year, 1,200,000 last year. Contribution margin ratio. Contribution by sales into 100. This year 20.83%, last year 33.33%. 2. Calculation of break-even sales in pesos this year and last year. We have calculated contribution margin ratio for this year and last year in the previous presentation. Now, fixed costs 340,000 this year, last year 340,000. Break-even point sales, fixed costs by contribution ratio, that is equal to 1,632,000 pesos and last year 1,020,000 pesos. 3. Margin of safety this year, last year. Budgeted sales this year 3,600,000, last year 3,600,000. BEP sales 1,632,000, last year 1,020,000. Margin of safety sales minus BEP sales, that is 1,968,000 this year, 2,580,000 last year. 4. Calculation of operating leverage for this year and last year. Sales 3,600,000 this year, 3,600,000 last year. Less variable cost 2,850,000 this year, 2,400,000 last year. Contribution 750,000 this year, 1,200,000 last year. Less fixed cost 340,000 this year and 340,000 last year. Profit this year 410,000, last year 860,000. Contribution minus fixed cost is the profit. Operating leverage is equal to contribution by profit, that is 1.83 this year, 1.40 for the last year. 5. Expected sales volume increased by 15%. This year expected is 115% of the last year. So, number of units 30,000, expected 34,500, selling price 120, expected 120. Sales volume quantity into selling price 3,600,000 this year, expected 4,140,000. Less variable cost quantity into 95, 2,850,000 this year, 3,277,500 in the expected contribution. Sales minus variable cost 750,000 this year and 862,500 for the expected. Less fixed costs 340,000 this year, 340,000 for the expected. Same. Profits 410,000 this year, 522,500 for the expected. Increase in profits 522,500 minus 410,000, that is 112,500. Percent increase in profits 27.44, that is 112,500 into 100 divided by 410,000, that is 27.44%. Recap. Thanks for watching. Please subscribe to our YouTube channel Accounts Lobby for various solved problems and lectures on accountancy.